Hey there traders, today we're going to be covering a bearish position called the long put spread on today's How to Trade Stocks and Options podcast. This is the How to Trade Stocks and Options podcast brought to you by 10MinuteStockTrader.com, where we give you the tools, tips, and tricks to help you trade faster and trade smarter. And here's your host, voted one of the top 100 people in finance by Redwood Media Group, founder and head trader of 10MinuteStockTrader.com, Christopher Uhl. The How to Trade Stocks and Options podcast is produced in partnership with my friends at FinClub.ai. I use the artificial intelligence data from FinClub as my primary indicator. I don't even take a trade if FinClub doesn't show me that I have a greater edge than any other traders in the market. You've heard the stats, 90% of traders fail, which is why you need to find an edge, and FinClub has that edge for you for just a few dollars a day. The returns produced by FinClub have been shown to be more than double that of the market, with win rates as high as 90%. I mean, they basically make it so easy. They're going to show you exactly what stock is going to exactly what price. Basically, they're handing everything you need to you on a silver platter. Listen, they are so confident that this will change the way you trade. FinClub.ai is going to give you 2 full weeks to test drive their service, and they'll even give you all their historical results so you can see exactly how it works and how it can dramatically change the way you trade. And that's exactly what I've done. So head on over to FinClub.ai to start your free 2-week trial, and I'll even throw in some extra bonuses after you sign up. Now, the only place you can get your discounts and free bonuses is at FinClub.ai. That's FinClub.ai. Hello, it's Christopher Uhl from 10MinuteStockTrader.com, and today I have another bearish strategy to go over with you today. It is called the long put spread. Now, a long put spread, what does that mean? Well, we are going to be buying this trade here. Long, in trading terms, means you're going to buy something. Short means you're going to sell it. In this case, it's a long put spread, so we're going to be buying some puts. This has also been known as the bear put spread, and it's called a bear put spread because it's a bearish trade. It profits when the price of the underlying goes down, and it's with puts. And it's also called a put debit spread because you're paying a debit in order to make this trade. Now, the max profit on the trade, as it says here, is the width of the strikes, which this case is 98 to 99, so that's $1, minus the debit paid. And you see down here, the debit paid in this trade is 50 cents. So the total profit in the trade, max profit, is 50 cents. And that's per share. So on a one lot, this would be a $50 trade. Now that's the max profit. The max risk is the debit paid, which is also 50 cents. So it's very simple. It's not very complicated here as far as what the profit is. It's essentially the difference in these minus what you paid for it, and the max risk is what you paid for it. Now, the ideal setup on this is low implied volatility rank. The reason being is because we're going to buy this trade. And anytime you buy something, you want low implied volatility, because implied volatility is essentially how high the prices are. So by having them low, you can buy it for less in price. And to do this trade, we sell an at-the-money put. So that's here. And then we're going to buy an in-the-money put, which is this one here. And this number here is the at-the-money strike price. The current price is essentially at the at-the-money. Now, sometimes I do like to buy these where they're both in the money. So we'd be selling the put strike here and then buying the put strike here. That does sometimes lead to higher probability of profits. But the key of this is being able to move the break-even point at or behind the current price. And by behind, I mean we want to make this at least a 50-50 probability trade. And that's why we're taking in 50 cents on the dollar, right? So this is a 50-50 trade in this example here because it's $1 wide. We're taking in half of that width. That means that as long as this is a liquid product, meaning that it has a high trading volume, that this is a 50-50 trade. If we were to put this where I was saying here earlier, where both strikes are in the money, I might pay $60 for the trade. But then that becomes a 60% probability of profit trade. And for me, I always look to increase my probability of profit more than increasing the potential profits themselves. Less to worry about, less headaches, less management. That's how I look at it. Now the break-even point on this is the put strike that you're buying. You're buying the 99, and you're going to take away the debit paid. So it's 99, which is our put strike here, minus 50 cents, the debit paid, makes our break-even point 98.50. So here is 98.50, which is midway in between these two. Now, the gist of the trade is essentially a long put spread. The put is doing the work. And if you're familiar with what a long put is, it looks like this. It starts down here, you've got losses, and then it at some point turns and becomes profitable as the price of the underlying goes down. Now, the reason that we sell a put against it, when you sell a put, a sold put's a bullish position. So sold put looks kind of like that. Now, the reason we sell a put against it is twofold. First, we are reducing the break-even point, or I should say we're moving the break-even point from there out here, right? So if this is our long call that we just bought, or long put that we just bought, we're moving the break-even to this price or better because of the put strike that we sold. That's the number one reason. And the second reason for me is that it increases the probability of profit. We're reducing risk in the trade. I mean, most likely, if you bought this, you're going to be paying probably at least $1.50 for it. And now, by selling one against it, you're reducing the risk in the trade by, in this example, you're reducing your risk by $100. And anytime you're reducing risk and increasing your probability of profit, that's enormous. And that's one of the reasons why this is a great strategy here. You're reducing risk, you're increasing your probability of profit, and in this case, you have the potential to make 50% on the width of the strike. Yeah, this is a great trade that I like to put on when I'm looking at a bearish position, looking at a bearish trade in a low implied volatility environment. That's the key here. If this is a high implied volatility environment, I'm not looking at it. It's not even on my radar because it needs to be low because I'm buying the trade. So there you go. That's everything you're going to need to know about how to put on a long put spread. It's a strategy that I use all the time. And in fact, if you want to learn more about how I trade and the strategies that we use, head over and take our free masterclass at 10minutestocktrader.com/free-training. And in there, we'll share our top 3 secrets, including stock hacking, how to get a 20 times greater return with 20 times less risk. The secret number 2 is the how to use artificial intelligence and how we let trades come to us using artificial intelligence. Stumbling over my words there, geez. And number 3 is geez, I am totally drawing a blank here, and I'm gonna let this stay. Our number 1 trading strategy. There you go. I learned it from Steve Burns. It's really great. It's how to minimize risk and maximize reward at the same time. And you can use that absolutely with the long put spread that we covered today. So listen, thank you so much for tuning into today's How to Trade Stocks and Options podcast. Make sure you go and check out the free training. And remember to enable notifications, like, subscribe, and do all that great stuff. That way you never miss any of the tools, tips, and tricks that we upload every single week to help you trade faster and trade smarter. And I'll see you in the next episode. Hey, thank you so much for listening, and before you go, remember to head on over to finclub.ai to get your 2 free weeks of artificial intelligence stock picks. You've got nothing to lose and only the most advanced AI to help you trade with confidence at finclub.ai. That's finclub.ai. 10minutestocktrader.com content is for information and educational purposes only. It is not, nor is it intended to be, trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested. 10minutestocktrader.com and Christopher Uhl, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10minutestocktrader.com and Christopher Uhl are not in the business of trading securities trades, nor does it direct client commodity accounts or give commodity trading advice, tailored to any particular client situation or investment objectives. 10minutestocktrader.com and Christopher Uhl are not licensed financial advisors, registered investment advisors, or registered broker-dealers. Stocks, options, futures options, and other financial instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment and financial trading decisions, and for evaluating the merits and risks associated with the use of any financial security and broker platform. For more information, please visit 10minutestocktrader.com/legal. and thanks for stopping by.